Hello and welcome to this session brought to you by the Academy of Practical Accounts in conjunction with your institution. In this session, we're looking at the recording of expenses, an expense refund, and the numbering of documents. So the objective is to identify and record the source documents, then trace the double entry and identify the annual reports affected by that. So we'll look at the source documents, the recording forms, trace the double entry, and identify the affected reports. Now, the first source document we're looking at is a receipt for cash paid. Now, if you could remember, we're putting an annual transaction onto a single document with the aim of getting an annual picture without recording lots of documents. Now let's see how we're going to record this allowed expense. Now remember, we're using a single form to record all allowed expenses, and ideally those expenses are going to end up on one expense account, which is number 25. So when this form comes, okay, there's a document number here, but let's assume there is no number there. And we're going to get that number from the source document. So what we should do now is to change to the horizontal alignment. Okay, this is the recording form for all allowable expenses. The date is pre-generated, and remember the documents should be arranged according to month to save the time of recording a document for each and every document. So you can put it around the month end, and all documents in March can be recorded using one date, which is preset. It's about saving time. And then this side, this form comes with number 4. And ideally, we should be copying the document number onto the document. So we are matching this transaction to a document. In case of need to verify, there is only one single document, number 4. And of course, the financial month and the financial quarter we can ignore because those are pre-generated, especially at the time of setting the financial year. Now, this one comes with a narration to save time, which can be modified. Can modify that narration, and we say, okay, we're going to call it resale stock. Okay, resale stock. That's not a problem. And then here the amount is 39.20. Now if you note, there is VAT on the source document. But this is a small business whose turnover is less than 82,000. So it's not registered for VAT, and we are recording the amount including VAT. So that VAT cannot be claimed. Simply forget about it, and it's an expense to the business. Now this was paid by cash, and cash is pre-selected, although we can always change that. Just click the drop down and change that to any paying account. As you can see, you can scroll down as you wish. And then finally up here, all expenses, there's only one account. There's only one account to save time. You don't have to bother to classify the expenses. It's only one. And that's it. So now we're ready to click save. We save and next. Save and next. The reason for that is we're going to use the same form to record the refund. Okay, so let's scroll down and look at the document for the expense refund. We don't need this. We look at the document for the expense refund. Now this is a refund voucher received for resale stock was returned to the supplier because it was faulty. Okay, so what we're going to do, instead of using the 2-entry form, we simply reverse the amounts here. Now, when the expense is paid for, we record a positive amount there. When we get an expense refund, we record a negative amount there. So we're going to record a negative 60 in there. Now remember, we ignore the net and VAT figures because the business is not VAT registered. And then we can modify. Now remember the document number. This form comes with a document number. Ideally, it identifies the last recorded document number and it generates the next document number to save us time. So we copy that document number from the form onto the document. So there is only one document number 5 in the business for that financial year. There's no confusion. Now we can modify the narration. We can say faulty stock returned. Okay, faulty stock returned. That is faulty stock returned. Good. Returned. Okay, we click on the device. Got our 60 amount there. Now the cash account, well, it was received in cash form, and the account to credit is 1. We only have one expense account. That's where all the expenses should be recorded. And now we're ready to save. So we can save and close. Okay, that's it. Now the next thing to do is to look at the double entry and then the accounts affected by this transaction. So let's rotate this and we're going, okay, let's drag this up. We're looking at periodic tasks and reports, and then we're looking at report P5, which is the general ledger. And we are not looking at transactions in month 1. That match is month 12. Okay, we scroll down and look at month 12. So we're going to trace the double entry. Now let's pinch this. Let's pinch this. That's good. And maybe we expand this to give us a better display. Yeah, that is better. Let's try down here as well. That's about it. Now, transaction number 1 was that investment. Number 2 was the sales income. Number 3 was the refund. Number 4 was the purchase of resale stock, and number 5 is the return of faulty stock. So number 5. So ideally, we don't use the purchases returns account. No, we use one expenses account, and this 60 reduces the amount paid initially of 13,920, and that leaves us with 13,860. And of course, it's a similar effect to the cash account, although that is not clear simply because there are other transactions on the cash account. All right, so this is a double entry for all the transactions recorded so far. Now, the other task is to identify the reports affected so far. Now, all the reports highlighted are affected by this transaction. So let's start with the short tax return quickly. Let's click back there and we click back again. Let's see. Yes. Now let's start with the cash register very quickly. It's not on that list, but not. Okay, let's look at the cash register very quickly. Now, essentially, this cash register shows the movement of money in and out of the business. And now we're looking at month 12. Ideally, this is the cash account. Now, the difference between this one and the monthly cash account and the annual cash account is that this one shows daily balances. So if there's another date, it will show what has happened on that date. how much money has come in and how much money has gone out, and what the balance is. So what we have here, this 33,500 was received from sales, which was actually reduced by 120. That was paid back to a customer. Then 13,920 was paid for stock, but then 60 was received back. So from all those, we have a balance of 19,520. So that's the cash register. So let's go back and look at the dashboard very quickly. The dashboard is an overview of the business. Now we're going to look at this in the next session. So we can have a quick look at the dashboard. Is profit and loss account, tax and income update, and then the balance sheet below. Right, let's go back now. Let's look at the short tax return. We are going to our mini year-end reports checklist. So we'll look at the short tax return here. And the short tax return here, that's what it looks like. We've got a turnover of 33. We've got cost of goods for resale at 13,860, and the net profit before any adjustment is 19,520. That's a quick snapshot. Now let's go back. Let's look at B1, B2. We're really having a very brief look at these. We shall look at them later. B2. Now this is what the balance sheet looks like. Let's see this balance sheet. We've got a bank balance of 400. We've got a cash balance of 19,520, which sums up to 19,920 total assets. And then we've got a 400, which is capital that was added, and there's a net profit of 19,520, which sums up to 19,920. That is equal to the net business assets, and there's no difference. Okay. Now, which other report can we look at? Let's look at the final trial balance. Let's look at C1. C1. Ideally, your life is made easy by just clicking a button. Let's pinch these to fit on the screen. So those are the balances. So far, we have affected only 5 accounts. And if we are to wind up accounts at this material moment, that's what those are the balances we find on the final accounts only. Now let's see the other reports. We'll look at them later. But ideally, this is what is affected. At this stage, you have the liberty of checking each of those reports. Now we've got G3, stock and materials accounts. Let's have a quick look at that. Report G3. Now, where is G3 stock and materials account? Yes, very quick one. G3. Yeah, that's it. This is what we have on report G3. Ideally, your work is made easy. There's nothing like manual. All you need to do is to extract information from a source document, and thereafter, you click a button and reports come onto the screen. And after the report is displayed on screen, the next thing is to print the report. You generate a PDF, you print the report, you file the report, and that's it. And of course, thereafter, we're supposed to submit the tax return to the tax authorities. So all the reports highlighted in yellow have got data. We shall look at those in turn. Well, I think that brings us to the end of this session, where we looked at the recording of all expenses, a refund, and the numbering of documents. And please remember, we used one form for recording both the expense paid and the expense refund, and that is form number 2. So when recording an expense paid, we record a positive amount in the top box. When we're getting a refund for an expense, the expense account balance should be reduced. So there's a negative there, and the cash balance should be increased, and we end up with a positive in the lower box. And that's the end. In case of any questions, please give us a shout on either Skype, probably WhatsApp, but Skype and email will definitely be available. Thank you so much, and bye.